Hello, welcome to chapter 9, welcome to week 10, welcome to accounting for liabilities and specifically for current liabilities with an emphasis on payroll. So there are a number of topics for this week. I want to remind you that there are 5 weeks left of class, 3 weeks before Thanksgiving and then 2 weeks after Thanksgiving. Of course, some of that depends upon when you're listening to this presentation, and it might be that you're listening to this presentation much later, so that content isn't even relevant. But Chapter 9 is about accounting for liabilities. Chapter 9 starts on page 476, and it gives you an introduction, an opening to the chapter. It reminds you that we have a continuity concept in accounting, and the continuity concept states that businesses will remain in business for an indefinite life, an indefinite period of time. That makes them a going concern. They're going to be in business for as long as we can envision at this time. Therefore, we need to use accruals and deferrals to assign activities to particular time periods. And we use adjusting entries then to wait until the economic effect of the transaction has occurred, and then to recognize the economic effect in the period in which it occurs. And then we'll get good matching. We'll get the revenue in that period, we'll get the expense in that period, we'll have the amount those will appear in the income statement, we'll get the amount that's going to benefit the future into the balance sheet. And so that's what we're trying to do with adjusting entries, and it's going to be the same for liabilities as it was for assets. So remind you about this going concern concept, and that business will be in business indefinitely. Therefore, we have to allocate these costs to particular time periods. On page 478, they have accounting for notes payable. Now, we've seen notes payable before. We've seen notes receivable before. So notes receivable were the assets that we saw when somebody was going to pay us. These are going to be notes payable when we're going to pay someone else. So the journal entry for this note payable is on page 478, and we're debiting cash, the asset, to make it go up, and we're crediting notes payable, the liability, to make it go up. So now we have more liability than we had before, but we also have more cash than we had before. And we now know the terms of this liability. You saw in the chapter on cash what a note looks like, how it has the interest rate and the dates and the repayment requirements. And we've had those same specifications about assets. So now we're putting them to liabilities. So now we have a loan issued on a particular date with a particular interest rate with particular terms of repayment. And then on the next journal entry we have is about interest expense and interest payable, the adjusting entry when we have to recognize some expense due to the passage of time. And then we have a second adjusting entry with the same debit to interest expense, credit to interest payable. In both of those cases, the expense went up in 1 year, and the obligation to pay this back went up in by the same amount during that year. As we look across the page then to 479, I want to introduce you to compound journal entries. You've seen them before, where you have more than one debit or more than one credit. But in this chapter, we're going to begin to see rather large compound journal entries. So on page 479, we have interest payable and cash. Interest payable is being debited, so it's going down, and cash is being credited, so it's going down. So we've paid off some of that interest, and then just below that we have debit the note payable, and it's going down, and debit cash, and it's going down. But those two entries all pertain to the same transaction. So if we look down at the bottom of the page, we should just write one compound entry. There's no need to write all of these single entries. So if we look down there, we have interest expense, the amount of interest that's due for this year. We have interest payable, the amount of the interest that has been due for a prior year. And then we have notes payable. All of those are debits. The first one is an expense. The next two are liabilities. And then finally the credit to cash for the full amount that we owe, the $98,100. So we want you to see that you have this note payable, you accrue the interest as it's due by debiting interest expense and crediting interest payable. Then when the time comes to pay it, you don't have to write all these single journal entries. You can write a compound entry for the interest expense that's due in this period, for the interest payable that's due from past periods, and then the note payable itself would be debited as it's going down, and then the cash. So that tells us about notes payable. Now the formula for interest is the same formula you've seen all semester. All semester you've been asking me, now what's this equation? Where do I see it? And most times it's buried down in the discussion, as you can see that's happening on page 479. The interest is buried down there in the discussions, and then on the top of 478 and then on 479 it's buried in there again, right in with the discussion. But when you turn to page 480, when we look at page 480, we've got that interest expense in bright blue print right there in front of us, broken down by the components, and it's rate times time times amount. So I want to review it for you again, show it to you, same formula you've been using, and it's on page 480. Now, next topic is accounting for sales tax, and that's on page 478 and 479. And the situation here is that you're a business, you're selling items to the public, and you're collecting sales tax on behalf of the state as an agent of the state to collect the money for the state. So in this particular example, the sales tax rate is 6%, which is very nice and round. I don't think in our counties right now it's nearly that clean and even. But you would multiply the sale times the 6%. In most of our cases, it happens on the cash register, and you push the sales tax button and the 6% of whatever the final sale is comes up. A lot of times you don't even have to push the button. As soon as you stop putting items in, it tells you the total, and it immediately tells you the tax. It's pre-programmed to calculate the tax immediately without any further human interaction. And so then the debit is to sales tax pay. The debit is to cash for the amount of the sale. The credit is to sales and to sales tax payable. So the sales tax payable is a new account for you with this chapter. It's a liability, it's a current liability, and it's a liability to send that money to the state taxing authority whenever it's due. So if it's due at the end of the month, or it's due every week, or it's due on the 1st and the 15th, or whatever the requirements are, that you would pay that sales tax off to the state. So on the top of page 481, you see the journal entry to debit sales tax payable to make it go down, and then to credit cash to make it go down, and you send the cash on to the taxing authority for whatever you have that's due. So that is sales tax payable. And that is a new account for you with this chapter. The next account you have is contingent liabilities. And contingent liabilities are a potential obligation arising from some past event where the obligation specifics depend upon a future event. So you have a past event that's causing an obligation, but you don't know the specifics yet, so that you can't really calculate an amount. The classic example of this is a lawsuit where some past event is being contested and it's in court, and the case is being heard. Now, depending upon how early or late it is in the case, you can make some estimates about it. But what the accountant has to do is to determine how we will disclose this contingent liability. So we have three options. If the accountant and management determine that the loss is probable, we're probably going to have to pay this, and we can get a reasonable estimate of the amount, then we write a journal entry and book it right then. And we make that from a contingent liability to an actual liability, a realized liability, and we recognize it in a journal entry, and so we've disclosed to the public we have this obligation. Now, if the determination made by the accountant and management is that the loss is only possible, it's not probable yet, but it's possible, then what we do is we disclose it in a footnote, and we say it's possible that we would lose so much money in a lawsuit that's underway at this time, and we don't write a journal entry to disclose it, we just disclose it in footnotes, and that's possible. So a contingent liability can be disclosed in footnotes. Now, if the contingent liability is determined to be remote, it's not likely to happen and it can't be estimated reasonably, then we don't do anything with it. We don't disclose it at all. We just keep a file on it and we watch it to see if something's going to happen. Now, if it is the case of a lawsuit, for instance, and the suit has gone to the jury and the jury has given us a verdict and we're appealing that verdict, well, this is probable because we already have a jury conviction. So now it's only a matter of how much might the amount be, but it will at least be the amount that the jury awarded. Shouldn't be more than that, but it would be the amount the jury awarded, and it might be less. So due to conservatism, we write the journal entry showing the amount that the jury awarded, and we say it's probable that we're going to lose that amount or maybe less. And in the footnotes we could tell why we think it would be less. Now, if it hasn't gone to jury, if it has just gone to jury and we don't know the outcome, or it's towards the end of the case and people are talking about certain amounts, then we disclose that information in a footnote. So in the footnote we say that the jury has the case at this time, or the case is under consideration, it's in progress, whatever it might be. And we can tell about that in a footnote. If somebody is just saber rattling with us, if they're just saying, I'm going to sue you, that's too remote. We don't disclose that to anyone. We wait to see what might happen. So they discuss this on page 481, and on page 482 they have a nice schematic disclosing just exactly what I'm showing you here. So if you look at the contingent liability and you read the 3 points on page 481, and then you look at the schematic on 482, you can begin to see how we disclose or decide not to disclose this information to the public. Now the next topic we have about current liabilities starts on page 482 and ends on page 483, and it's called warranty obligations. And a warranty is when you sell a product and you agree to replace parts on that product, or you agree to give back a new product, or you agree that for 3 years you'll do the labor maintenance, or whatever the terms of the warranty are. So on page 482, the first journal entry that's shown there is the sale. So we have the cash and the sale. Cash is going up, sales are going up. The next one we have is cost of goods sold are going up, and inventory is going down because we don't have that inventory any longer. So we just have that classic sales entry in event number 1. In event number 2, at the end of the year, we're going to have a new adjusting entry, and we're going to recognize the warranty expense obligations that we have. So we're going to be debiting warranty expense, and we're going to be crediting warranties payable. And so warranties expense will match the cost of this expense against the revenue that it generated this accounting period, and then the warranty payable will be the liability, the obligation to fix that product whenever the customer comes and says this needs to be replaced or this needs to be fixed, or please look at this and tell me if it should be fixed or if it should be replaced, however the scenario works out. So now this new journal entry that we have, this adjusting entry that we have, requires that management make an estimate, and generally they do some sort of they use a time series analysis, and they look at revenues, and they look at revenues over time and warranties over time, and they decide the relationship between revenues and warranties. And in a time series analysis, that's year by year, they say 3% of sales or 10% of sales. So when you look at the top of page 483, and they say the amount of the warranty and reported estimate on the financial statement is to be $100. They've done some sort of an analysis like that, and are asking that this journal entry be written, this new adjusting entry be written. So the adjusting entry in most of these problems will be stated for you either in a dollar amount, as you see here on page 483, or they'll be stated to you as a percentage, 3% of sales or 1% of sales, something like that, or 0.5% of sales are to be recognized. So then you write this adjusting entry, debiting the expense, matching that expense against the revenue that was generated this period from those products, and then setting up the payable, the liability, the obligation to fix the product when need be. And then if you look down at event 3, it tells you that there's a settlement obligation. Somebody's camera has broken and they've sent it back to us, and we are fixing it, and when we fix it, it cost us $40 to fix it. So now we have this liability set up, an obligation to make good on our warranties. So we debit our warranties to make that obligation go down some, and we credit cash for the $40 that we had to pay to buy those parts or to do that labor or whatever it was, or to sometimes it can be warranty payable and inventory, because you're sending out a whole new machine or a whole new asset. So as we look at warranties, that's a common liability and a new account and a new adjusting entry for you with Chapter 9. So you want to learn that one, think about it, and know how that one works. And then on page 484 and page 485, you've got these general ledger T accounts. So you have those in Exhibit 9-2, you've got those transactions up there at the top. We wrote the journal entries on these pages we just reviewed. We posted those T accounts that are present, and at the bottom of the page we have the income statement, the balance sheet, and the statement of cash flows for those liabilities. So as you look at them, you might want to look at the liabilities, and the warranties payable are that current liability right there, and then the warranty expense is shown in the operating expenses after the gross margin in the income statement. So you want to notice where that is disclosed. And then when you're looking at the cash flows, notice that there was a $40 operating expense cash flow that went out because of having to fix that product. And then we have that as a reduction, as a negative cash flow, because we had to pay it out. The check yourself on page 485 is a nice review of the warranties, and you could begin to see how the percentages are presented there on page 485. So if you get it, the warranty stated to you as a percent, then you would follow the math on page 485. Now then, the next topic is payroll, and payroll is quite a long presentation. It's on page 485 to 492, and accounting for payroll is a process that you should at least be aware of, so you know where your own paycheck's coming from, and you know what's happening behind that piece of paper that you're receiving, or that electronic transfer that shows up in your checking account followed by the piece of paper. So we have these steps that we go through. They start on page 485, and the first one they list for you is identifying the employee. Now the issue here is which person is an employee and I'm responsible for their employment, and which person is an independent contractor. They're going to take care of their own taxes, and I'm not responsible for them and for their benefits. So the decision that's made there is this person my responsibility, and so they're my employee, or are they an independent contractor, and are they responsible for themselves both in their work and in their tax obligations? So that's the first decision that we make. The second calculation we have is gross earnings. And before I go too far on this, I want you to know that the Excel lesson that you do for Chapter 9 to learn Excel and to apply Excel to accounting concepts is about payroll. So it's about these pages 485 to 492. So those 8 pages are what you're going to want to be looking at and following and putting into your Excel spreadsheet. So that moves me on to gross earnings. Gross earnings are based on the regular 40-hour work week. And so how many hours did the person work at their straight pay, their standard pay, their normal pay? All of those kinds of words are used to calculate the first 40 hours. Then you look at hours over 40, greater than 40 hours, 41 and on, and those are overtime amounts. And so you'll have to calculate the overtime amounts. And then you'll add those two together to get the gross pay, the full amount of their initial pay for the time worked. And so gross pay is the sum of the 40 hours of regular work plus any overtime work. Next comes deductions. And as the word would imply, deductions means less, so it's going to be less deductions. And there are several types of deductions, and they're listed here on the pages, with some of them given as examples. So you'll need to be familiar with each of these deductions. There is federal income tax that the employee has to pay to the federal government, and again you act as the collection agency on behalf of the federal government and withhold federal income tax from their check. The next one is state income tax. and you also act as the agent to collect the state income tax, and etc. There's other types of taxes that the employee has to pay, and you become the agent that collects that tax, and it's a deduction from their paycheck. Next one that we're going to talk about is Social Security. And just before I leave federal income tax, on page 487, they show you the salary expense, the federal income tax payable, the liability, the obligation to pay that to the federal government, and then the cash. And we're going to be just building on that initial start of deductions. And so then the next one that we're looking at is the federal income tax documents that we all fill out when we go to work. The W-2 is here, the W-4 is here, whatever we fill out and we give to our employer or we get back from them at the end of the year. And then next comes Social Security, and next comes Medicare. So they are on page 488, and so we're going to deduct a certain percentage of the check for Social Security, and the employee has to pay an amount for Social Security, and then the employee has to pay for Medicare. So we're going to deduct a certain percentage for Medicare. Now if you look on page 489, you can see how they disclose that Social Security is 6% and Medicare is 1.5%. Now remember that that's 6% is 0.06 and that 1.5% is 0.015. You move that decimal place 2 places to the left. So you want to be sure that when you see this, it'll either be disclosed in a table like this or it will be disclosed in the problem itself in part of a sentence. So you want to make sure that you can find those percentages. After Medicare, at the bottom of page 489, they talk about voluntary withholding deductions. A voluntary withholding deduction would be a charity. Many times the employer will match the charity, so that'll create another transaction for the business. Many times it'll go to something like a credit union where there's an automatic payment that goes to the credit union. But these are on the page of bottom of 489 and top of 490 are these voluntary deductions that come out of your check. And then when we get through all of these deductions, now we had federal income tax, state income tax, Social Security, Medicare, and voluntary withholdings, those 5. And so we're going to get to net pay. And on page 490, and I'm going to hold this up so you can just begin to see it in the on the camera. In this first box on page 490, the withholdings are presented to us as if they were a statement or a schedule. And down here, they're presented to us as if they were a journal entry. So here in the bottom, we're seeing the debits and the credits. Now notice that we get salary expenses being debited because that's the expense of hiring the person. And then we get the credits to all of these obligations, these liabilities, and then we get the credit to cash, the amount of the asset that's actually going down at this time to pay the employee. So in our example, the wage goes from $6,000 to almost $4,800. So it goes down by $1,200 that we're withholding from this example, from this employee, and that we're going to give to other places as the employer. So when you get to page 490, stop and look at that journal entry, stop and notice how the deductions are listed, and then we will show you in a few pages how all of these liabilities are credited for this journal entry. Remember, every one of these debits and every one of these credits are posted into a general ledger T account, and they change the balance of that account. So then next topic in this chapter is the employer payroll taxes. Now remember that, and maybe you don't know it, but when you read the chapter you'll discover that the employer matches the employee in taxes such as Social Security. So in Social Security, the employee paid 6%, but the employer has to pay 6% as well. So when we look at employer payroll taxes, it's FICA, which is Social Security, and then federal unemployment tax that employers have to pay. So you'll notice that in the employer tax, which is over here on page 491, and it's in this box right here, we have the Social Security for the employer, we have the Medicare for the employer, we have the federal unemployment tax and the state unemployment tax for the employer. So we have 4 payment obligations that we're now creating, 4 additional payment obligations that we're creating for the employer. It's going to be an expense to them, but it's going to create an obligation to pay that at some point, a new liability. So just below that schedule is the actual journal entry where you're debiting the expense and you're crediting all these payables. So in that one journal entry, we've added 4 more liabilities for you, 4 more payables. So you want to be sure that you look at them, study them. You're going to have to write them down. There's a lot of new liabilities in this one chapter. One thing to remember is in assets, we started out much more slowly. We didn't have all these accounts in one chapter. We had more chapters because it was early in the class. We need to introduce you to the chapters. We were teaching you a lot of other things such as the theory of debits and credits and writing journal entries and those sorts of tasks. And then we applied those tasks to accounting accounts. Now what we have is all these accounts in one chapter. So you're going to have to sort out these accounts. And many times you ask me, is there just one place where we can find all these accounts? And unfortunately, sometimes there is, but unfortunately sometimes there isn't. So it's important that I tell you where these are. And I've even gotten to the point of holding up the book and trying to show you so you can see where they are. Now the check yourself at the top of page 492 is about checking yourself on doing these calculations, shows you the math, shows you the multiplication, the times, and shows you the percentages, but it shows them as a percentage, so be sure that you can convert them back into fractions. And then it introduces you to the next new kind of liability, the additional kind of liability, and that is the fringe benefits. So how the employer records their or its payroll tax is on page 491, and the employer has their part of the tax obligations to recognize and to set up the liabilities that they'll have to pay for their obligations. And then there's one more, and that's the fringe benefits. Most professional employees, most long-term permanent employees have fringe benefits. And so they have the fringe benefits that they identify in this chapter are vacation pay, medical insurance, and a pension expense. So those 3 expenses, every payday, certain amount of a payment goes to those expenses and creates 3 more liabilities for you. Vacation pay payable, medical insurance payable, and pension liability. Now at some point you're going to transfer that money off to those agencies, but every payday you have to recognize the employer's portion of those expenses. And generally the employer pays those on their own. Sometimes the employee will match on the pension, but sometimes the employee might match something on the medical expenses, but that just depends upon the nature of the contract that the business has. But when you look at those journal entries, be sure you're taking note of these liabilities. I think there's close to a dozen new accounts, a dozen new liabilities in just Chapter 9. Okay, now if you have any questions on any of these journal entries, be sure that you come by my office, send me an email, ask in class, come to class just to ask if that's necessary. So I'd be happy to help you. The next part of the chapter then looks at the financial analyst. And of course, once we get to the financial analyst, we're very close to the end of the chapter. So now there's a discussion again about current and non-current accounts, classifying accounts between current and non-current. We saw this earlier when we were first working with assets. And remember, current accounts are accounts that will have to be converted to cash in the next operating cycle or in the next fiscal or calendar year. Now, the technical term is whichever is shorter. Generally, businesses use the calendar or fiscal year because that's consistent. It always ends on December 31st for the calendar year, or it ends on a particular date, June 30th, for the fiscal year. The operating cycle is the number of months, the amount of time that it takes to take your cash, acquire your raw materials, convert the raw materials into a product, make the product, distribute the product, sell the product, and collect back the cash. So it's oftentimes called the cash-to-cash cycle. We take our cash, we buy raw materials, we hire labor, we make products, we ship those products, we sell those products, we collect the cash. Now that operating cycle is not constant, it changes in time. You wouldn't want to be changing the current and long-term portions of the balance sheet every time the operating cycle changed. So that's one of the reasons now that we use the calendar or fiscal year as a general practice. And that's what you'll see in this textbook. But you need to be aware that the operating cycle can be used if necessary. So on page 491, they list the current assets, and those are all the current assets we studied in those earlier chapters. So they're all listed right there for you. You can look back, and they should look familiar. Now, when you turn the page, you can see the current liabilities, at least some of them, that have been shown to you in this chapter. And those are liabilities that will have to be paid with cash in the coming year. So the assets will be converted to cash. They're cash coming in. The liabilities are cash going out. So there are two different calls on the working capital current cash. Now when we look at the classified balance sheet on page 494, it has the current assets, and then it has the long-term assets, and it has the current liabilities, and it has the long-term liabilities, and then it has stockholders' equity. So as we look at liabilities and assets, we're breaking them out between their contribution to cash, whether it's going up or down, over the next 12 months, or the operating cycle, but the next 12 months generally, or if it's going to be longer term than 12 months. Now, we've worked with this before, but only periodically. From now to the end of the class, you'll be seeing it more. So you want to be sure that you get that current and long-term idea down in your thinking. Now, across the page, there's a new ratio for you, a ratio that we're introducing these ratios and thinking about how we use the financial statements. This one is called the current ratio, and it's current assets divided by current liabilities. And so it's explained on the top of page 495, and we would like the current ratio to be something greater than 1. So we'd like to have $1 of assets for every $1 of obligation we have to pay. And ideally, we'd like it to be greater than 1. We'd like to have some cushion in there that we have more cash than what we have obligations. And this is called solvency, liquidity, how much cash we have to fulfill our obligations. And that ratio is a very common ratio. Remember that in the back of the book, every time we work with these ratios, I turn back here to show it to you again. And I guess there's always a picture of me looking down at the book, but I think it is, I was thinking it was C, but the financial statements are B. The financial statements are a lot of pages. So let me turn to Appendix C. It is Appendix C. I'm remembering that correctly. It has all of the ratios, and it tells you what chapter we learned about them, and it tells you an explanation of them. So Chapter 9 is at the bottom of page 755, and there you have the current ratio, and then the other ratios that we're going to learn in future chapters are also presented back there in Appendix C, starting on page 754. So back there at the back of the book. As we see how this chapter ends, there is a real world experience and gives you some companies that you will see and recognize, and you can look at their current ratio and their debt to asset ratio and begin to see that different information that those ratios tell us. Now remember, ratios, when you get to finance in BA 360, ratios will be kind of a first step of beginning to look at and understand the financial position of a company. There will be many more sophisticated investigations into the financial status of a company when you get into finance, but these ratios will be in Managerial Accounting 252 and again in finance. And for now, we're learning these in accounting. They're very simple. They give you glimpses. They help you begin to ask some questions about and get some understanding about the operations of a business. But they're the first step of investigation, and you'll learn more steps of investigation in future classes. Well, that brings me to the end of my discussion of current liabilities that will have to be paid in the next operating cycle or the next year. And these are generally paid more frequently than once a year. And then also really focusing in on payroll, so you begin to see the types of obligations that a business has towards its employees. The appendix then to this chapter, I guess before I go on to that, I want to tell you to be sure that you look at those current liabilities and make your own list if you need to, or mark the page where you see each new set of liabilities, because there's no place where there's a full list of all of those liabilities given to you in the chapter. Even the list at the back wasn't a full list. It was an example list. Now on page 497, there is an appendix. And that appendix is about accounting for discounted notes, or for discount notes, as they're sometimes called. And when, up until this point in our study, we have had notes that were interest-bearing notes, and so the interest was added on. It was an interest-bearing note. It was for $10,000, and it was 6% interest, and so we added 6% more and paid back principal plus interest and gave more cash than the amount of the note that for which we signed. And so we've been doing face amount as interest-bearing notes. So the face amount of the note plus the interest. There's another kind of a note, and that's the one we're looking at here on page 497, and it's called a discount note. And here the interest is included in the face amount of the note, and the cash proceeds that you get from the note are less than the face amount of the note. So you get less cash, and the issuer of the holder of the note keeps the interest beforehand. They keep the interest at the time that the loan is issued. So you get less cash. They have use of their interest all the time. So the effective interest rate is higher than the stated interest rate. The stated interest rate might be 9%, but the effective interest rate could be 10.5%, because you're not getting use of all the money. So you especially want to study these discounted notes. Again, it's a concept you want to mark, because you're going to use this again in Finance 360, and you're going to probably see it somewhat in Managerial Accounting 252, but maybe not as much as you'll see in Finance. So here we have, starting on page 497, the discounted amount is repaid at the cash value. However, the interest has been withheld from the beginning of the loan, resulting in receiving less cash. So we have 2 years of transactions. 2013 start on page 497, and then 2014 are presented over on page 500. So this goes from page 497 to 503, and we get a series of transactions. So I'm going to work you through those transactions. Event 1 is that you borrowed the money by issuing a discounted note. So when we look here, the terms are a $10,000 face value note. It's 9% interest. It's for 1 year, and the interest is withheld from the note. So if you look down, you'll see the face value is $1,000 less the discounted interest of $900, which the holder of the note holds back that much cash, and then the actual cash proceeds that you get, the amount of money that you actually get to borrow, is $9,100. So you're going to receive $9,100. They'll hold back their $900 of interest, and then you'll repay $10,000. So you're going to be seeing that money you will be receiving $9,100. So when we took that, the $9,100 becomes in effect the principal on the loan. So when we turn the page, we're going to see a debit cash, because that's how much money we're going to get. So we're going to debit cash for $9,100. We're going to see the discount on note payable, which is a contra liability. It's an account. It's a contra liability. It carries a debit balance. It's used to reduce the liability to its face value, its cash equivalency value. And then we see the note payable of $10,000. So when we actually look down the page a little farther, we see notes payable, a liability for $10,000, less the discount on notes payable for $900, and we get the carrying value of the liability, which is going to be the note payable of $9,100. Now the $9,100 is how much cash we actually get from the cash flow. So if you look back up here, the cash flow from the financing activity that will go in the cash flow statement is $9,100. So as we start working and paying attention now to the cash flow statement, we've worked with the income statement, we've worked with the statement of change in owner's equity, we've worked with the balance sheet. We're going to turn our focus to determining the cash flow statement. We're going to be looking at these cash flow statement informations in our textbook, each transaction. So then let's look at the rest of the transactions that happened in 2013. They recognize the operating expenses, and you know how to pay expenses. Across the page on 499, they recognize the service revenue, so they get the income. You know how to recognize income. But then in event 4, they want to look at the interest expense. Now, here are the conditions to determine the interest expense. The loan was issued March 1st of 2013, and it's a 1-year loan. So you'll have March through December, or 10 months, 10/12 of interest will have to be recognized in 2013. And 2 months, January and February, 2/12 will be recognized in 2014. And then the end of February, you'll pay the loan back. So as we look at the adjusting entry that has to be written at the end of 2013, we're going to take $10,000 times 9% times 10/12. $10,000, the amount of the loan, 9%, March through December, 10/12. And we'll get $750. So we'll debit interest expense and credit interest payable. Debit interest expense for the amount of the loan expense on this note, and credit interest payable for when we're going to pay the loan back later. And then as we then turn the page, we can see that journal entry, debit interest expense, the discount on notes payable, that obligation is going to be going down. So we're going to credit that, I think I said credit interest payable. That was a mistake on my part. I apologize for that. We're actually going to be crediting the discount to amortize the discount and make it come back down to 0. So debit interest expense, credit discount on the note. Now, when we turn the page and we see the transactions at the top in Exhibit 9.7, and we see the discount on note payable here in the middle of the liabilities, we see that the beginning balance was $900. We had the adjusting entry of $750, leaving us a $150 balance, and that will be the amount of the expense for next year. Then we have the interest expense of $750 over in the equity accounts as an expense account. When we look at the income statement, we have $750 of interest expense. When we look at the balance sheet, we have $10,000 still in the note, but we have $150 in the contra liability. So now the book value, or the cash equivalency value of the note, has gone up from $9,100 to $9,850. It's getting closer and closer to the amount we need to pay back at the end of the loan. Now, what I really want to point out too is over in the financing activities in the statement of cash flows, we find that we have $9,100 inflow from creditors, and that was the cash proceeds of the loan over there in financing activities. In 2014, we then look at the recognize the accrued interest for 2014. That would be done on February 28th, just before we're going to pay this back. $10,000 times 9% times 2/12, January and February, 2/12. And so that's $150. So we'll debit our interest expense and credit our discount. When we credit our discount, it fully amortizes that discount. It goes to 0. And now the cash equivalency value of the loan is $10,000. And then when we have to pay back the loan, we just debit notes payable and credit cash, which is the very next entry that you have on page 501. Now we go through the same processes. We recognize our revenues, we recognize our expenses, we put into the T accounts. Now when we look at the T account for the liability, the notes payable, we have a note payable of $10,000. We have a discount of 0. So our face value of the notes payable are $10,000. And now notice across the page, on page 503, we have interest expense of $150. We have liabilities, they're completely amortized. The discount is fully amortized, the loan is paid, so we don't have any note payable at all by the end of 2014. And then what we have is in the cash flow statement, we have $900 of interest in the operating cash flow that we've paid out, and then we have $9,100 of financing activities, cash outflow when we paid back the loan to the creditors. So in 2013 that money was coming in 2014 that money's going out. They're both in financing activities, but one was an inflow and one was an outflow. So now we want to take the time to look at these financial statements, think about them, think about how they're presented. Well, that brings me to the end of chapter 9, and I want you to know you have my full empathy for the number of accounts you have to encounter and learn and work with in one chapter. And I think, though, that based on the strong learning you did with assets and with writing journal entries and posting to T accounts and keeping track of account balances, this will be easier for you because you have that foundation on which to build. Now it's just to apply it to liabilities instead of to assets. What I'm expecting to have happen is the accounting won't be so hard, because you know how to do that. The hard part's going to be learning all these liability accounts. I hope that's all. I hope that's the hardest part for you. Well, welcome to chapter 9. Thank you for listening to this discussion, and may you have good learning about liabilities.